That I get, Vikas, is that it's the financials that are the best place to be given the balance of risks. But even there are concerns about bad loans, about unsecured credit. How are you approaching that area of the market?
Again, this is a sector that we've been very active in for a very long time, and we've had a diverse collection of names in the portfolio. We have fewer, by name count, we have fewer underweights today. We have virtually no presence in the public sector banks. We have concentrated our holdings in the private sector banks, but only a small handful of them. We have lessened, in calendar Q2, we lessened our exposure to the NBFCs because in Q1 they had done so well, and we're always focused on prospective returns, which we didn't find as appealing. But then also we started looking at the credit costs starting to creep up. If you look at the NBFCs that lend to the auto sector in particular, weak earnings, even broader consumer lenders in the NBFC space, there's some stresses that we're seeing there. So when you stack all these things up, it's not been a great earnings season, even though expectations were lowered after the last two quarters. Calendar Q4 was a poor quarter for the market. Calendar Q1 started off very poorly for the market again. So even though expectations have lowered, we're not seeing very many beats yet. There are some, but they are far and few and far between.
You said, just circling back to IT, because you said that was the largest underweight that you have. Is there a long-term concern that you have that was perhaps aggravated by what we learned from TCS and these severe job cuts? And I relate that to AI displacement. How are these companies positioning for what could be a huge opportunity, but in the short term is creating huge wrinkles in terms of transitioning the workforce?
Yes, so the operating environment has changed. Now, I don't want to sound the death knell for this sector yet, because for the last 25 years we've heard the same things, whether it was Y2K or the cloud. The sector went from strength to strength over the last 20 years. But this does, dare I say, feel different, seem different in the earnings delivery, in the outlook, in the commentary. It's not very encouraging. And then you layer on top of that the valuation and other opportunities that we're seeing. Our capital is finite, so if we need to buy something in the IT services sector, we need to be selling something else, and I don't see that compelling of a trade-off. I do think that things have changed for the sector. Also, what we should remember is the job creation here had for a very long time been the path from to success to climbing the social ladder for people outside the metros. That seems to be shrinking. You hire one person in the IT services sector, but you also indirectly hire a driver, helpers. You fund the real estate sector, not at the premium end, but at the low to mid end. That is going to face some challenges when it comes to growth as well. If you look at housing starts for the lowest ends, if you look at the housing finance companies, much lower demand, much slower growth than at the very highest ends. And I think that's going to slow down. And there will be questions for the longer term as well as a result.
And let's bring in those questions, very palpable questions that were raised because of the jobs report, softer numbers there. And we know that the IT services sector has been trying to price the growth concerns in the US market and the fall off in enterprise demand associated with it. How bad is it going to be for, let's just look forward to the day today and the session today. Do you think that the IT services, because of the jobs numbers in the US, are going to take a big hit?
Some of these concerns assuredly are in the price already, but it doesn't feel like, again, even though I said it's not a monolith, if you look at everything in aggregate, it doesn't seem like the worst of the pressure on jobs in this sector is behind us yet. And we'll see how the next couple of quarters go. But if you look at utilization rates, if you look at the churn, if you look at the hiring practices of the larger companies, they're hiring higher and more specialized people, but they're reducing senior people with areas of expertise that are less valuable today than they once had been. And when you start cutting at that level, the higher cost level, then that reduces the path higher for newer hires and younger people. So I do think that the pressure will continue. This is in the context of a large, diverse market where we're seeing 2, 3, 4 IPOs being launched daily. So the overall broader opportunity set in India is increasing. We remain very constructive on Indian equities for the long term, but these are legitimate concerns. If you look at sector by sector, credit costs in NBFCs, hiring practices in IT services, auto OEMs, the sales have not been very inspiring. But then you have strength in other segments of the market, which are very exciting, and that evolution will continue.
That two-wheeler sales number that we saw in June was one of the worst for quite some time, and these are bellwethers of India's economy.
They are.
What's that telling you?
Well, again, it's saying that at the lower end, the demand is not where it should be, neither for staples nor for autos, lower-end autos. At the higher end is where you're seeing a lot of the improvements, whether it's Indigo or some of the real estate companies, some of the hospital, the healthcare services companies. But there's certainly a sense that growth is slower than where people were expecting it to be. If you look at some of the infra capex numbers, the domestic-focused infrastructure companies, their order books have been growing more slowly than the companies that are able to tap into opportunities abroad. All of these things are cyclical. Nothing is permanent. Again, as an active investor in India, we remain very excited about the opportunities that we're seeing, but it just highlights the importance of doing your homework.
I wanted to bring in the